What is up, everybody? So I am going to have my friend Stewart Heath on with me in this podcast. I've known Stewart for a few years now. We were actually in a capital raising mastermind called Raise Masters that we had joined. And Stewart is a great, great guy. We had a lot of fun talking. We discussed everything real estate and everything life. So I hope you enjoyed it. And coming up, Stewart Heath. What is up, everybody? Welcome back to another episode of Raw and Relentless with Bo DePaoli. I have got my friend Stewart Heath on with me today, and Stu, super excited to have you on. Could you tell the audience a little bit about yourself?
Sure. I am a CPA. I've been in Middle Tennessee, Northern Alabama my entire life and career. I really got into investing in real estate around the year 2000 after sort of an epiphany. And it had to be an epiphany because I had been taught early in my career, like in the late 1980s, early 90s, that real estate was bad. The Tax Act of 1986 sort of destroyed a few asset classes for a few years. And so there were people running around that, saying that real estate was bad, and I was very young and an impressionable young business person. So I sort of walked around with that attitude, and then started seeing what some of my clients were doing through my CPA practice, and like, yeah, this isn't bad. So and so that was my epiphany, and got into it and just realized how much I loved it and loved doing it.
So how many years have you been investing in real estate now?
About 25.
Oh, wow. You are seasoned then.
Yeah. Everything I've learned the hard way. So.
That's the best way to learn, right?
Yeah. It sticks with you that way.
That's for sure. So what kind of assets are you investing in?
Right now, I pivoted from commercial several years ago, so we will do anything commercial sort of in our geographic area, which is Northern Alabama, Southern Middle Tennessee. We currently have storage, medical office, also suburban office is what I call it, and retail in our portfolio. I always chase and I will underwrite multifamily deals. They always seem to be a little bit too pricey, a lot of competition. We like to deliver to our investors deals that cash flow from day one. And so that's really hard to do with a multifamily deal.
Okay. So out of the assets that you currently own, which category do you think performs the best?
Storage.
Really?
Yes.
Interesting. Because I was reading...
For us, we just walked away from a storage acquisition last month that was underperforming, and we knew how to fix it. But then, their occupancy, which was already pretty bad, was deteriorating. And we got a little spooked. The seller wouldn't retrade the deal, and because you do come across those storage facilities every now and then that seem to plateau around 65 or 70%. And while I don't really think that would have happened in this area, I got spooked, and we couldn't get it for the right price, so we walked away. So.
Sometimes that's the best thing to do, right?
Sometimes the best deal you do is the one you didn't do.
That's right. That's right. What do you think is second best? I'm trying to see if my guess is correct.
What's really interesting right now, it's retail.
Really?
Yes.
So my guess was going to be
it's one
medical.
of the hottest asset classes of the year. So
that surprised me. I thought for sure it would be medical. So why do you think retail?
Well, right now we are in a season of just incredible growth in rate per square foot. And everything these days comes back to the pandemic. So, if you recall, retail was dead and gone, and nobody would ever go to a store again, and everything would be delivered by truck and stuff. Well, wasn't true, but that did stop a lot of retail development going on almost everywhere, even in markets that didn't really suffer as bad. And so now it's just a very simple supply and demand thing right now.
Mm.
In the markets that we cover, we've seen a 60% increase in rate per square foot on renewals.
Wow.
I know it's just like what a fabulous time to be owning the asset, and I'd love to say that we planned it this way, but it's just accidental brilliance on our part. But so that's what's doing the best now. Medical, you're right, is just a year in, year out great performer. It can't move that fast because almost everybody has a 10-year lease, and so there's somewhere in that. So you don't get you'll get big bumps at renewals
Mm.
and things like that. No, it is a solid cash flow generator.
So on the retail side, are you seeing is it mostly coming from like large anchor AAA tenants, or are you dealing with a lot of like local style retail businesses?
What I strive to do in our retail properties is to have a balance of those that you just mentioned. You need the local people who are going to fill in, and then you want national chains. We're not doing big anchor strips or anything. These would be almost infill type product, but they are infill.
Mm-hmm.
So yeah, I've got one that's about 25,000 feet, and another one that's 15,000 feet, and we like to have a nice mix of restaurants and other service providers, dentists, chiropractors, dry cleaners, things of that. And when we do those, we like to see somebody who's got a franchise. It might be locally owned, but they'll have some sort of franchise oversight. Or even the restaurants that we want them to be multi-unit operators. They
Mm.
might be local, but it might be the third Mexican restaurant of this local group. I just generally won't do a first-time restaurant for anybody.
Okay.
Yeah, the success rate on those things is just horrible,
Yeah.
and it's about an 80% failure rate in the first 5 years. So
Yeah. Which is most businesses, right?
yes, yes.
Um, Now, when you're going out and you're looking at these assets, are you using your own capital, or are you raising capital? How are you acquiring these style assets?
We are syndicating, so we are sponsors and operators. We, of course, put our own capital in the deal as well, but then we do syndicate it out to our network of investors and our network of other capital raisers. And so we will co-GP the deals with other capital raisers. That's how we've come to do bigger deals.
Okay. And so, with some of these assets that you're looking at, what's some of the return metrics that you're offering your investors?
They usually ramp up from year one. So our target before we will move forward with a deal is with about a 70% loan to value on a stabilized asset. We want to be able to deliver a minimum of 5% cash on cash return year one. If the leases are structured correctly, there'll be annual bumps in those, and usually we can find a way to tweak net operating income upwards as well, so that will increase the cash flow. And at the end of the day, they end up being fairly boring, nice deals. The investor gets their cash, they'll get their bonus depreciation, and then a few years down the road, market conditions
Mm-hmm.
allowing, we'll refinance the property and send them some cash back, on a tax-free basis, and sort of set up and do it all over again.
If you do that, well, I have two questions to that. First one
Sure.
is, if you're doing a refi, a capitalization event where you're refining, and let's say you return the investors 100% of their initial investment,
Right.
does the deal structure change for your investors then, where maybe the GP gets a larger percentage now?
I get nothing until they get 100% of their investment back plus their preferred return.
Mm.
And that will change from deal to deal. So And then once that happens, yes, we start to get some cash flow after that, and that it's fairly standard the way that works. So that'll be anywhere from 30 to 50% of the cash flow from that point on.
Okay. Now, you mentioned depreciation and bonus depreciation, and I know that it's different for different asset classes, right, based on the IRS code.
Yes. Yes.
So can you kind of explain, I think, is multifamily, is it 27 and a half years or 35 years?
Multifamily is 27 and a half years. That's considered a residential asset class.
Mm-hmm.
And every other class that's not residential is 31 and a half years.
31 and a half. Okay. So the storage, the medical, the retail is all 31 and a half. Correct. And then you mentioned bonus depreciation. So how does that work?
Way back in the 50s, they put this thing in the code called the investment tax credit, then they brought it back a little bit in the 70s and early 80s, which meant that you could reclassify all kinds of different assets associated with real property as personal property. And so anything that's not real estate is called personal property. Doesn't mean that it's like your personal asset. So the provision in the code to reclassify assets from real estate into personal property, which means a shorter depreciable life. That's mm-hmm. what that really means. Mm-hmm. You're going to go from 31 and a half years to 5 or 7 years mm-hmm. in most cases. Mm-hmm. So huge difference. And so that's been around for a year, and they have utilized that over the years to provide incentives. Well, the latest iteration of that is the bonus depreciation that was put in until the 2018 Act, which meant anything that was personal property, you could write off in the first year. Now, it's been staggering down. For the first several years, up and through 2022, it was 100% bonus depreciation. 2023, it went to 80% write-off of anything that was personal property. This year, it's 60%. Next year, it'll go to 40%. And it's scheduled to go away until Congress, re-ups it, which they'll likely do next spring, because they all like to get reelected, and they pay taxes too.
Right.
So it all comes down to how much of your investment is personal property, and so the faster you can write it off, the faster the benefit, and the lower taxes you pay, which increases your cash-on-cash return.
Now, this is different than cost segregation, or is it the same?
No, the cost segregation is the process by which you identify personal property that's embedded in your real estate.
Gotcha.
That's the process. Mm-hmm. So, and even back in as early as 2004, Hospital Corporation of America, which is a big local mm-hmm. HCA here in Nashville near me, they actually won that right for all of us, because they took basically 10 years of taxes to the Supreme Court, and that was actually settled by the Supreme Court in 2004, which they pioneered the process, and they won the right for everybody to do cost segregation through a court case, which was settled in 2004. And then the IRS continued to fight it for several more years. Now the IRS has capitulated, and they actually have guides on how to do it. So it is a standardized part of the law now.
And that was a healthcare facility that did that?
Yes, Hospital Corporation. If you can imagine, you ever been to a hospital that
Sure.
wasn't remodeling or something?
Yeah.
And so they identified, and again, they stood on the piece of the code that was created in the 1950s to be able to identify what they could write off immediately without having it last 30 years and that kind of stuff. So
I'm a little confused, because I thought that most healthcare is non-for-profit. Am I wrong?
Hospital Corporation of America is a for-profit public company. There's a lot of for-profit hospital companies out there as well.
Gotcha. Okay.
Good question, though. Yeah, it is a bit bewildering, So.
Yeah. Yeah, that's really useful information because I think most people, well, let me backtrack. Why? Because I think from the layman mind thinking is why should all these real estate people get this depreciation? Why should they not have to pay taxes? And so what's the IRS's thinking behind why depreciation is good for the property owner?
Well, if I can change the premise of the question a little bit,
Sure.
the IRS does not think depreciation is good. I've been across the table with them many times. It's Congress that thinks it's good because they're the ones writing the laws and stuff like that. And I think Congress's point of view is that we have a real estate based economy, and we always have. And even though we have been a wildly tech-driven economy since the year 2000, we're all still real estate based, and that's housing primarily drives the world, and then all these other asset classes follow housing. And so, if you want to generate some economic activity, you give people incentives to go out there and drive housing. And spillover effects of that, because obviously if you've got bonus depreciation, it's everybody that works in the real estate. So if you're not building something, but let's just say you're a grading contractor, and which means you get hired by people who are building something, but you've got to go buy $500,000 pieces of equipment to go do bigger and better jobs. Hey, you're going to get to write that off in year one. And that means more guys will be able to afford to buy more equipment and so forth and so on. And so greater, and history shows greater economic activity actually increases revenues to the Treasury and doesn't necessarily reduce revenues, but you give individuals incentives to do things. So,
and so when you get that 100% bonus depreciation in year one, and let's say that depreciation amount is more than your taxable income, do you then get to carry, because then it becomes a loss, right? Do you get to carry forward that loss into the next year?
Yeah. The rule is you cannot create or increase a loss by use of this. So you get to take it down to zero.
Oh, okay.
And then whatever you didn't use, you carry forward. You cannot carry it back because there are some losses you can carry back, but you get to carry it forward. So it's the gift that keeps on giving. And so, because the next year you can buy another big piece of equipment, and so it gets to be quite complex keeping up with all the asset purchases and things like that.
Yeah, I kind of explained this in my second podcast that I did, where I kind of explain how the real estate game kind of works, and I used a multifamily property as an example because I think most people don't understand that anyone can do this. I mean, anyone can go out, and I use an example of going out and buying a 12-unit building, right, multifamily building, and I don't think that people understand how much benefit there is in real estate, not only in terms of a passive income play, but also from a tax advantage on what you get with depreciation and reducing your taxable income. It's huge.
Yeah. The tax impact becomes highly individualized because it is somewhat limited or enhanced by your own personal tax situation. But if you are a real estate professional, which anybody who's directly owning and managing their own real estate, I mean, the benefits are huge. I think that the returns from real estate are about 1/3 come from the taxes. I mean, and the cash is already pretty good. And then you've got the capital gain piece that comes from the assets. And these days I get asked every day because I'm bringing something out that's going to return them a 5% cash on cash return. Now it's, well, I can do that good with a CD. Yeah, you can. but for how long?
Hmm.
And the CD will give you no tax benefits, and it's certainly not going to give you a capital gain. The only thing it's got on real estate is you got zero risk, and the risk return trade off is as old as time. So,
Hmm.
and most investors get
Right.
that. It's just been so long since anybody been able to put their cash anywhere and get something more than a 0.5%. People like 5% CDs,
Right.
um, even though that wasn't keeping up with inflation, a year ago.
Yeah,
You're
totally.
still losing money. You just
Yeah,
feel better about
right,
it.
right. Exactly right. And plus, the other thing too is that when you go to sell that property, any profits that you make from the sale, you can 1031 into a new
You can.
property and not pay taxes again.
That is correct.
It's
Yeah.
just keeping that wheel moving, right?
Yes. Yeah. The tax benefits. I think under the current law, I think the tax benefits of just capital gains is pretty great. But yes, there are many other avenues to reduce or defer taxes. Maybe you've got something in an enterprise zone or an opportunity zone.
Hmm.
Maybe you can 1031 it, and there are other kinds of local opportunities that you can look into your personal holding.
Awesome. I want to ask you something that I actually had a call with a guy. This has been a couple of years, and I was kind of skeptical, but since you're the CPA, I'm going to ask you. I understand. The only reason I got the call was because I put a blog post out about this 1031 exchange. Because again, this is another thing that most people don't understand. So I did a blog about the 1031 exchange and explained exactly what we're talking about. He reached out to me. He does. He does this style of trust where you put all of the assets in the trust, and so you don't have to worry about a 1031 exchange because the trust owns everything. The profits aren't taxed until death, I believe is what it is. Does that
The
sound
Delaware
right?
Statutory Trust. Yeah,
Yeah. And so you're familiar with this?
I am.
And so this is legit. So you could actually put all
Oh
of your,
yeah,
your assets in there and not,
yeah.
but you individually can't own the assets. The trust
That's
owns it.
correct.
And I think it's
Yeah.
you cannot somehow you have to delegate the trust to somebody, correct?
Yes. You have to trust somebody. That's correct.
Yes, yeah.
Yeah. Um, yeah. Yeah. I mean, I think DSTs are fascinating. I think that they are problematic if you're going to try to use debt as well,
Hmm.
because it's my understanding. Now, I am familiar with these. I have never done one of these,
Hmm.
but it's my understanding that you can't even guarantee the debt, um, and that would somehow, uh, you know, uh, trigger a breaking of the trust. It's my understanding. But yes, it is completely. There's actual investment funds that are all developed as DSTs these days, so you can just like passively invest in a DST, and then you know the trust management is going to run around and do all the investing, and they're just going to send you cash and stuff like that. It is quite fascinating, and I think it works really well in the perfect situation.
Mm. Interesting.
Yeah, and it is quite a bit broader than
Hmm.
a 1031. But even 1031s don't work in every situation. They have to be right for you, and you got all these time windows, and
Hmm.
you gotta hit them just right. So
Right, exactly. Yeah, it has to be similar, a similar asset. It has to be within. You have to what? Identify something in the first. Is it 60 days?
45 days,
45,
and then you got 180 days to close
and
on
then
it.
yeah, exactly. Yeah. Okay. Yeah, there's
And
always
these days,
stipulations, right?
yeah, these days identifying something in 45 days, that's a pretty tight window.
Very much
Because
so. I mean, myself alone on the underwriting on the multifamily side, I think I've underwritten probably 500 deals year to date, and there's only been maybe like two or three that have been
right,
worthwhile.
yeah.
So,
And what's the common denominator of why they haven't met your standards?
oh, they're just overpriced.
You're right.
They're overpriced.
Exactly.
Yeah, the market still has not, in my opinion, right? I'm no expert, but the market has not caught up to real valuations because they're still hyperinflated from the low interest rates and all of the attractive debt, and there is a housing shortage in the U.S., right? So there's not enough homes to house all of these people that we have and are coming into America.
Right.
So.
Yeah. Yeah, I last year there were hardly any deals to do because of what you just said. Now, January of this year, I saw a whole bunch of, oh, wow, I remember that property, and now they're back into the ballpark, and there was just sort of a flood of properties that hit the market that I felt like they had come a little bit to reality. But now you got this whole, those deals have probably been gone through, and now we're kind of back to, hey, it's not 2022 anymore.
Yeah,
it's the interest rates are 8.5; they're not 5.
Right.
And
you're not getting bridge at 3.
Right.
Yeah.
The sellers, I think those people just aren't really sellers.
Yeah,
they're fishing.
Yeah, there's actually not surprisingly, but there's been a lot of deals that have circled back from a year or two ago that never sold, that they're coming back to market with either the same broker or a different broker. They need to get out. They want to get out. Maybe they've got bridge financing that's coming due and they're not getting extensions or whatever. They just want out. They're not trading because just the deals don't make sense, Yeah.
I think most everything has to cash flow these days to make sense. And I think from a seller's point of view, that leaves money on the table that they don't get because they have to sell it at a price that, one, will be able to service 8.5% debt, and two, some excess cash for distributions. So, which are our requirements, and we're pretty focused on that because we're not doing any fix and flips or we're not doing any of that. We're just trying to buy stabilized properties at good prices. So.
Yeah. And I mean, a good telltale sign of a deal that just does not make sense is when you're walking in with negative leverage, right? And let me explain that for the listeners that don't know, and I'll use just a very simple example. If you're getting debt right now, like you said, at 8 to 8.5, but they're selling the property at a 5 to 5.5 cap, that's 300 bips that you have to make up somewhere in the deal over the course of your hold period, and that is extremely hard to do.
Yes, that is the first criteria that I look at, and if it's more than a half a point out, then I just send it on and wait to see if it comes back around. Yeah, because I mean, you're not going to make that up. I figure the half point, I can negotiate the price down and get it to where I need it to be. Sometimes, but you're not going to make up 300 points. No possible way.
Right.
And
especially since now, rent premiums are not what they were doing 3 or 4 years ago.
Exactly.
These guys that were getting 10 to 15% rental increases, it's not happening. You're lucky to get 3% now.
Yeah, and in some cases it never happened.
Yeah.
I can remember a very specific deal in Nashville that somebody showed me, and it's a guy I know, and he was so excited that they had the contract on it, and they were paying a 3.5 cap, and the pro forma called for 12% rent increases, for the next 5 years. I just said, man, my spreadsheet won't even work like that. I could never publish that. I just, and frankly, I don't know if he's still above water. He probably is. They were pretty well heeled, but I imagine they're having to, add cash, every month to sort of keep it in there. And it was not I don't know what interest rate they got. They still had the chance to get it in the 4s or 5s, but I hope they locked it up as long as they could.
Sure. Yeah, absolutely.
But even borrowing at 5 and borrowing at 3.5 is still negative leverage.
Yes. Yeah. Right. Yep. Yeah, and even still, like there was a lot of hot markets right there during COVID because people were just vacating, let's say what it is, blue states, right? They were
Yep.
leaving the blue states and they were going to Florida, they were going to Texas, they were going to Tennessee, and those guys were seeing some really good rent increases, but that doesn't last forever. I mean, it's to the
No.
point now where things are starting to stabilize and things are starting to come to reality.
Yeah. I think we may see another phase of double-digit rent increases again for a short period of time in localized areas because of sheer supply and demand, just exactly like what I was talking about in retail.
Mm-hmm.
I mean, this is not going to last forever.
Mm-hmm.
Hopefully you can ride the wave, but it'll take 3 years, and then ultimately people start building more stuff again
Sure.
because what was the old Harvard Business School guy? Excess margins begets competition.
Mm-hmm.
And that's the way of development.
Mm-hmm. Is that where you, speaking of Harvard, is that where you got the name for your company, Harvard Grace Capital?
Harvard is my dad's middle name.
Oh,
So
okay.
yes, I'm completely knocking off that little school from Boston and from their logo, but it's actually my dad's middle name. So.
Okay, very cool. What else are you working on besides trying to gobble up all the medical and storage assets and retail assets in your neighborhoods?
That's pretty much what our focus is just finding more and more stabilized deals and expanding our investor network. We are playing around with some ideas around Regulation A
Mm.
because here's my prediction. Not that you asked, but
I want to know.
yeah. The only thing the stock market has on real estate is liquidity.
Mm-hmm.
Okay. The technology is here and people are doing it. If you've ever followed Arrived.com, that Jeff Bezos backed company that's doing pretty much single family homes, and now they're doing a fund and now they're doing notes. It's all Regulation A based. Um, yeah. Once you bring liquidity to real estate deals, uh, I think the party's just beginning
Mm-hmm.
for real estate, and most people, Wall Street likes to take real estate and call us alternative. And I'm like, yeah, we're not alternative. We're the original asset
Mm-hmm.
class, and we've been around since cavemen. And I just think technology is going to catch up with this, with the monetization or the securitization and tokenizing, and all this kind of stuff, where somebody who's got $100,000 and we will create a market, and markets are being created for these private investments now. So I don't know if it's 5 years or a little bit longer. So anyway, we are doing some research. We have no plans, but we're spending a fair amount of time trying to figure this out. Because if you go from what we're doing, where all of our deals are 506C deals, which means every investor has to be accredited,
Yep.
which I think actually makes things simple. But over in Regulation A, anybody who's breathing and over 18 years old is a qualified investor,
Mm.
and you can do it where they can put in $100.
Mm.
I've tested $100 several times over at Arrive just to see the experience, and they got this app, and I'm not kidding. It was easier to buy a piece of real estate property through them than it is ordering dinner for my family on the McDonald's app.
Really?
I mean, it was just that simple, because that's the idea behind Reg A.
Because Reg
So
A is you could utilize both accredited and non-accredited investors.
anybody over 18 years old, yes.
Wow. Without a
Yeah.
prior relationship or anything.
It is a backdoor de facto public offering. They don't require an S1. They once they approve your offering, you start reporting like you're public,
Mm-hmm.
but you don't have to go through the whole thing, and and it's just simplified. And I don't know how much money Arrived has raised at this point, but they've bought something like 5,000 houses, and they're doing 3 or 4 houses a week. And people just log on and start throwing 5 to 10. I think they said that their average investor has put in $850.
Wow. And I know Blackstone is doing something similar. Their big push is houses, BTRs, build to rents,
Yes.
and just houses in general. So with Reg A, and I think those are pretty costly to set up, right?
They are. They're not cheap, and they don't go very fast either.
And so how do you get the liquidity with a Reg A if you've got an investor that's able to use? Is it tokenized? Is that how they're able to exit so quickly?
Yes. Mm-hmm.
Oh, okay. But
So there's an actual exchange. So,
But you as the fund, or it'd be considered a fund, right? A Reg A fund?
yeah. Yes.
You have, as the fund, you have to have the liquidity yourself to be able to pay back that investor, right?
Yes.
Interesting.
Those are the things that we are trying to figure out, because is Reg A actually the exit vehicle for our original private deals? Do we use that to, or is it the bank?
Mm-hmm.
Do we raise Reg A funds to be the bank instead of going to a lender and paying 8.5%? I can pay these people a real estate secured 6% return, and it's better than what they're getting at the bank.
Do they get the depreciation too?
Probably not.
Mm-hmm.
Probably not. But I don't know. They might could.
Mm-hmm.
Yeah.
Mm-hmm.
Yeah. We
That's
could figure that out. It's a brave new world of all kinds of things, and I doubt we're going to be the first pioneers on it, but we're trying to figure it out. But the technology's here. It's just a matter for market acceptance, and I think we'll end up with 3 or 4 exchanges
Mm-hmm.
where people can trade their tokenized units.
It's kind of similar to a REIT, right? In a way.
Well, REITs are very specific tax vehicles. They are a trust, and so they have, and they are exempt from taxes at the trust level, but tax advantages don't pass through to the investors in the REIT either.
But somebody can exit a REIT fairly quickly, like you could.
Yes,
a Reg
if it's
A.
a publicly traded REIT.
Yeah,
yes.
sure. Okay.
Yeah.
Yeah.
There's plenty of private REITs too.
Yep.
So.
Yep. And
Yes.
I've even thought about that too. It was like, setting up almost like a private REIT fund, which, like you said, same thing, where you're just providing them a standardized return and using that as a bank as well.
Yes. To me, the biggest hurdle is, okay, if you're going to be dealing with people with hundreds of dollars and not hundreds of thousands of dollars, you've got to reach thousands and thousands of people now. So that becomes a digital marketing acquisition problem. And so how much money do you need to get that ball rolling? How much money do you need to raise your first $1 million? It's probably $500,000, frankly.
I think, don't quote me on this, but I think this is how Grant Cardone is doing some of his stuff, is through Reg A.
He is doing some Reg A.
Yeah.
He is doing some Reg A.
I mean, he's a marketing master, right?
He is.
So it would only make sense for him to do that. And that's probably how he's able to acquire some of these deals so attractively, because he's not giving those pref rates that you would with a Reg A.
Yeah. What Arrived is offering is it's 4% paid annually.
Wow.
So I got my $4 by January 15th. And well, hey, it worked. But they are sort of, I think, the leader in the market right now. Arrived, and And I've spent some time in their public filings, and they've structured everything as a series LLC. And so they file a new series about once a week.
Really?
Yeah. So I'm over here with my CPA hat on. So this sounds like a nightmare to me
Yeah,
because,
yeah.
every series is like a different entity.
Yep.
But I'm sure they've got technology that addresses all that. And so the public filings with the SEC are just pages and pages and pages long. But see, every time they do a new series, that does not require a new approval from the SEC. So they got approved once, and then they can expand. And with each series, they just, all right, this series will include these 6 houses. And sometimes it includes one house. 'Cause you can invest in one property on their deal, or a group.
Interesting.
Yeah.
And this is backed by
Very
Bezos?
He's a major investor in it. He's
Okay.
not running the company, but I would say Bezos backed. But yeah, he's on his yacht, so I don't think he's running the company. So
Yeah, his yacht with his new girlfriend. Yep.
yeah,
I'm not
and his
hating.
new yacht.
Yeah.
Yeah, his new yacht with his new girlfriend.
Yeah, yeah. And I think didn't they have to like dismantle a bridge in order for the yacht to get out to sea?
Yes.
I mean, that is serious fuck you money right there.
Oh yeah, and it's like I hope he made the engineers figure that out. I mean, pay for that.
Yeah.
Because it's like I'm sorry, that one's not my fault.
Right. Crazy.
Yeah.
I think that brings up a good point. Is like I think a lot of people have a lot of limiting beliefs about what's capable, and they have a very limiting mindset where they think that there's not that much out there in the world. But if you look at guys like that and Elon and all, I mean, there is abundance in the world. There is plenty for everybody, to be able to achieve that kind of lifestyle and do the things that, frankly, me and you are both trying to do, I mean, we're little fish in a very big pond, but the pond is big enough where there's plenty of opportunity and plenty out there for everybody.
Yeah, I agree. And real estate is the largest market on the planet.
Yes.
And far larger than the stock market or even the U.S. Treasury market or anything like that, which most people think of as the markets. But we're all physical beings, and we all got to be in some piece of real estate all the time.
Yeah, absolutely. Yeah. Stewart, it was really great talking to you. Do you have anything else you wanna throw out there before we part ways?
If it's okay, I'd like to let people know how to find me.
Yeah, please do. Yes.
Yeah, so you can find me at harvardgrace.com, which is just exactly how it sounds. There you can find my contact information. You can find my Calendly link, and I do invite anybody to use that link because I will talk to anybody about real estate pretty much all the time. We got resources there too that are free, cost you nothing but your email address. And if you're thinking about passive investing, there's some good resources out there for you, like questions you should ask your passive investment sponsor and things like that. So anyway, I invite everybody to reach out.
Do you got any deals that you're in the pipeline right now that you're trying to raise for?
I have one. It's a medical office building down in Birmingham. It's almost full. And then next week we will announce one for a new retail center here in Spring Hill, Tennessee, which it's brand spanking new. It's already fully leased. We will be ready to close, waiting on construction to be completed and COs before we close on it. But this one is this is a great long-term hold, good cash flow generator, and it's very close to a new interstate exit that they just opened up here. So lots of more traffic coming and coming and coming.
That's great. And are those deals sitting on your website for people to preview?
The medical office building is, but the second one is not, but it'll be out by the 1st of August.
That's great. Stewart, always a pleasure. Loved getting to catch up and chat with you again. Let's do this again soon, and I wish you the best of luck. And always, thanks for coming on. I really appreciate it.
Thank you, Bo. I really appreciate it.
All right, buddy.